following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Tom Schneider CMT with NinjaTrader. This is the Technical Analysis Explained segment of the show. And we're going to revisit a study that we looked at, probably about a year ago. And that was RSI. So why are we doing RSI again? Well, I think it's important to look at RSI, understand it, come back to it every so often. There is, it is the most, would say the most used indicator aside from a moving average as far as technical analysis goes. My experience, I'm sure Mike Burke's experience, Jim's experience, it's the indicator that I would come across the most on traders, analysts, charts, and for good reason. It was one of these indicators that really kind of changed the way charts and data was looked at back in the late 70s, 1978. There was a book published by J. Wells Wilder, and he introduced a lot of new concepts to technical analysis, and one of them was the Relative Strength Index, RSI. Now, one thing I do want to make sure before we go on is the RSI is Relative Strength Index. It is not relative strength. Okay, there is another concept called relative strength, and that is something you might run into and you might even see on charts. It's basically the comparison of two different markets. Could be a stock to an index. It could be one contract to another in the same asset class when we're talking futures. But relative strength is simply taking two items and comparing them. This is not this. This relative strength index is really how well has this market performed relative to itself. So it's a momentum indicator. It's saying how is the trend doing? In this case, I've got the E-mini S&P up. How well is the price doing now? And you could talk about it, look at the chart. You could say, wow, it's been up for the last 6 days. Today, a little bit of a retracement day, but it looks, pretty bullish, right? Now, in a longer term trend, it's kind of sideways. And even a longer term trend, you can come back and say, well, it came up here and it retraced a little bit. So maybe it's starting to turn down. So time frame is important. With RSI, what we're looking at is kind of a shorter time frame. The default tends to be 14 periods, and that's just what J. Wells Wilder kind of came up with as his preferred setting. But really what we're doing with the RSI is we're looking at the last 14 periods, in this case 14 days on a daily chart. We count, or we measure, I should say, up days versus down days, up bars versus down bars when you're looking at, let's say, intraday. But of the 14, the last 14 bars, it's not enough to say, was it an up day or a down day? So if we were to do that count here, we'd look at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So we'd look at the last 14 bars and we'd say, is it up or down from the previous bar? And we could look at this and say, okay, well, that looks like it's up. One, 2 bars are up. That looks like it's slightly down. 3 bars are up. This is definitely up above this one. 4, 5, 6. That's not up. That's not up. That's 7. That's up. 8, 9, 10. So let's say 10 out of the last 14 days were up days. That indicates that the market is moving up. But it also has to take into consideration how big that move was. So when it moves up, does it move up in a big way or a small way? So we kind of get this idea of what is the average move up over the last 14 days. When there's not a move up, when there's a move down day, part of that calculation is a zeros, right? So we'll have 10 candles where we had a move up. We measure that move. What is the difference between this close here on this bar and the previous day's close? We take that distance. And on days where it's down, like this day, we would just say it's zero, right? There is no positive movement. And you find out that average. And you do the same thing for the down days. So there are only 4 down days. There were 10 days where we'd mark that as a zero for the down days. We'd add that up and we would find an average. So you're kind of averaging the moves up and the moves down over 14 periods and then making a ratio. And that ratio is actually indexed. This is the beauty of what J. Wells Wilder did, was he just didn't take a ratio, right? Because different markets trend different, they range at different prices. Some have more volatility than others. And so when he indexed this market, this study to a scale, a fixed scale, it allowed us to look at different markets and compare them, whether it was something that traded like wheat in pennies or low dollars, or the S&P, which is trading right now over 5,000. We could compare them on an apples to apples basis. So what is the implication of the calculation for each day, each calculation, each bar? You'd get this calculation, and it would be on a scale of 0 to 100. Something towards the upper end of the scale is bullish. Something towards the lower end of the scale is bearish. So 0 is the absolute lowest you can go. That's basically having 7 down days, or 14 down days in a row. And a value of 100 on an RSI would be 14 consecutive up days. Now, that doesn't happen often. In fact, I don't even know if it's happened. Something that data miners could probably figure that out, but you can get close to it. You can get in the 90s. That's really extreme. That's a real extreme move. And the thought is the market can't sustain a trend like that. So when we get to these very high levels on the RSI, we tend to think of them as what's called overbought and oversold. So I've marked those levels on my RSI study. I've kind of changed the coloring, changed the style. I put them on as dashed lines because they don't change. They're a fixed level. And so I've got these levels of 70 and 30. Now you could change them if you like. You could change them to maybe widen that neutral area. 30 to 70 is considered kind of a neutral area. It's not really too overbought or oversold. You could widen that to 75, maybe even more. I think it was Connie Brown who wrote a book about RSI where she moved the goalposts depending on if we're in an uptrend or a downtrend. And I say goalposts, it's these values. So if the market's trending up, she likes to see a higher overbought level at 80. That just makes that more extreme. That just makes those values above 80 that much more important. So if it really gets overbought, it takes more to get to 80, right? But in an uptrend, you want to see that, because what you're looking for is, you're not really happy to know, or you are happy to know maybe if you're, let's say, bullish and it's overbought, but really what you're looking for maybe is when it's changing, right? If you're riding the trend, okay, I want to be on this trend until it changes. So you want to know when it changes. You don't necessarily need to know just when it's overbought. So 70 tends to be the standard overbought level. 30 tends to be the standard oversold level. And the idea is, let's understand when it gets above 70, or let's understand when it gets below 30. because then I'm thinking, okay, well, this market could be, ready for a correction. And we can see there are different times where that market could be overbought for a little bit. Excuse me. So here we saw we crossed above 70. This is December last year, and that market just kept going. This market kept trending. And when it saw a little bit of weakness, we pulled back below 70. Now, some people might use that as an idea. Okay, we're going to turn around and we're going to continue to go in that direction. That doesn't always happen. Maybe it's just a pause in the trend and it resumes. So different things can happen. This is a bounded scale, 0 to 100. So we have to remember that we're kind of confined in our calculations. I mentioned Connie Brown moving the goalposts. If we're in a downtrend, she might move the goalposts to 60 and 20. She might shift down in the direction of the trend. She'll move those goalposts. And so an oversold level of 30 becomes an oversold level of 20 that becomes much more interesting to her, that when we get there, maybe the reversal is a true recent low, and something to take advantage of. So you can take your own ideas, you can apply them to these studies. NinjaTrader makes it very easy to customize. I do want to get back to that concept, though, of indexing and putting this value on a scale, because when we look at a lot of different asset classes, and you might only trade one future, that's fine. You might look at the E-mini or the NASDAQ or the Russell or the Dow, or maybe only trade gold or crude, that's fine. But if you tend to look at other markets, and sometimes it's good to look at other markets, even if you're not trading them, you can make yourself more efficient. You can be more efficient. Software can help you, because we can take that information that's in a chart and put it in our market analyzer. So over here on the right, I've got just a quick setup with a market analyzer. I basically opened it up and added a list of symbols. And of course, you could add more here and you could arrange them nicely and do some other coloring, but this was kind of a quick thing to do. And you'll notice over here on the right, it's kind of hard to see, is let me see if I can spread this out. We're going to forego the charts a little bit and go over to the market analyzer. I'm just going to move it over. Let's see if it stretches out way too much. So I've got my instrument column here. I've got my last price. So where is it trading now? Net change, I haven't color coded yet. Daily volume, I just want to know what the volume is. But over here, I've added a column for the RSI. So I want to walk you through how to do that, because it would be nice if we're looking at our charts, no matter where we are in our charts, whether it's a weekly chart, daily chart, 5-minute chart, a tick chart, whatever it is, I want to be able to see the RSI from a daily chart. I just want to know, what is this market doing in terms of momentum? Is it overbought? Is it oversold? Because that'll help me form my bias for trading for the day. So I'm going to right click in the market analyzer and go to columns. This is where we can define these columns, and you get a set of default columns. I think it's instrument, bid ask and last, something, kind of traditional. And I take out the bid ask price and I put in net change of volume, but I can also go to the available columns list and go to instrument. Now, instrument is just one of these really, it's one entry among a bunch in the columns, but it's very powerful because this allows me to pull in different instruments, indicators, studies, whatever you want to call them. I'm just going to add, and we're going to replicate what's up there now. And so when I add it to my configured window down here, I have to pick which instrument. I'm sorry, I'm doing this wrong. Let me remove this. Not instrument. I'm getting the language wrong. Indicator, the one above. Indicator is the one I want. Sorry about that. So indicator, I'm going to add. And what it does when I add it, it picks the first indicator in the list. Okay. So indicator right here, ADL. I don't want ADL. I want RSI. So I'm going to go to this drop down and scroll down to RSI. It actually is RSI. You don't need to look for relative strength index. Look for RSI. And so when I do that, it changes these fields. These fields adapt to the study. Different studies have different inputs and different outputs. We call plots. So in the RSI plot, we have RSI and then an average of the RSI. I don't use that average. I'm going to keep it as the RSI. So right now, the indicator will plot the RSI, but we have to tell it what data, what kind of chart do we want to pull from, right? So parameters, 14 and 3. So I'm going to focus on the 14. That's all I really need. I could change this to a different period if I want. 9 period is fine. Maybe it's a 21, whatever you decide. But I want to match what's on my daily charts. 14 is the default. Now I'm going to leave the close alone for the input series. That's what RSI uses. We're going to leave it as last as well. So kind of the same concept. I want the value that we're using in the chart. But here's the difference, the type. Okay. I don't want an intraday chart. I want a daily chart. I want one day. That's what we see when we look at a daily chart. I want the one candle is one day. So we're going to change the type to day, and I'm going to change the data to bars. Load data based on bars. And I'm going to change that. I just generally tend to bring in 100 days. I don't think it makes that much of a difference, although you do have to have enough bars to calculate the study. So at least 14. I would bring in much more than that. I'd try to bring in 100. Now, the question is, how do we calculate this? I don't want to calculate on bar close. That means that RSI figure will only update at the end of the session at 5 o'clock. I don't want that. I don't want to wait till the daily bar closes. I want to get it on each price change. Okay. It's a study that doesn't require each tick. The difference between price change and tick is a tick could be the same price for many prints, so to speak. A price change is really when the next tick is different than the previous one. We acknowledge that. So I'm going to keep that on there. Now, what I can do also, I'm going to calculate it to price change, and I'm going to change the label. I'm going to say something like daily RSI. So I can label it really whatever I want. I could change it to RSI, but that helps me clarify what I'm looking at. So if I'm looking at a 1 day chart or a 1 minute chart, and I look at the market analyzer, the column will tell me I'm looking at a daily RSI. So I'm just going to hit apply here and then okay. Now, I already had this up here. I left it in here as a check of sorts. And let's see if we can move these over so we can see those a little bit better. So here is the column on the right that we just added. And here's the one that was there originally. I'm going to shrink this back up. Maybe what I'll do is I'll get rid of some of those other columns so we can see them a little better. So I'm going to get rid of daily volume. I'm going to get rid of my original RSI column so we can just use the one we just created. I'll get rid of net change. And when we apply, we can see that a little better. So now what I want to do is I want to make sure that I'm actually looking at the daily RSI. Here we have the RSI down here for the E-mini, and I can see it's printing about 59.84. Well, that's what we have in our column. Now it's 86, and it's 86 down here. So I'm happy with that. I've replicated the RSI from the chart on my market analyzer. Why is that important? Well, that allows me to compare all of these markets and more if I add them and see which ones are overbought, which ones are oversold. There's one more thing I want to show, and we're not going to be able to see the benefit really today because we don't really have many markets that are overbought or oversold, but we can set you up for when you do. And what we can do is we can right click, go to columns, and that daily RSI, we can add some conditions to it. So I'm going to move this in the middle. You see where it says daily RSI. If I scroll down all the way to the bottom, you'll see conditions. I want to focus on sell. I don't want to worry about filter right now. It's got 0 conditions in here, but if I mouse over that 0 conditions box, it says add condition. So very interactive. I click and I can add a condition. Now it gives a default template. I'm going to change that. I want to know when something's overbought. I want to know when it's above 70. And I want to know that it's bullish. So I'm going to make it a green color. So here we go. Color for background. Right now it's transparent. I'm going to change that to lime green. I don't like the dark green. I like the lime green. It's a little brighter, a little happier, right? I'm going to change that color for background to lime green. And then when is that going to happen? Well, if I apply it now, and let's say I make it greater than, if I want to apply it to anything that's greater than 0, everything will be green. We're not going to do that. I want to change that value to 70. So now, if RSI peaks above 70, if it trades above, if it prints above, whatever you want to say, if it gets above 70 on the daily chart, the background will turn green. It'll actually pull my eye to the market analyzer to see that. Let's hit OK. Now, unfortunately, I don't have any markets that are showing above 70. But if they do, we've got the DAX is close at 67. Probably won't happen today, right? They're close. Wheat is at 68.5. And we have WASD numbers coming out. So that might turn into an overbought situation if the numbers are favorable. So that's when I might see something happen today. One other condition I would add is I would do the same thing. I'd add another condition. This time, I'm going to make a change if it's less than 30. So I'm going to change that condition right down here to less, change the number to 30. And I don't want green. That doesn't help me distinguish between the overbought and oversold. I'm going to change that to red. And I'm going to hit OK and apply. When I hit apply, nothing changes. We don't have any overbought or oversold markets. But when that happens, it'll help me identify that here. And then I can do further analysis. If, for example, the Dow was over 70, I've linked my Dow to the chart and it would populate that chart there. And I can do further analysis, whether it's intraday analysis or daily analysis with other indicators. But I would expect that my RSI value here matches this. We've already checked that. We know that's true. Now, one thing I want to talk about that's really helpful with this momentum study in particular, but momentum studies in general, is the concept of divergence. Now, divergence is very hard to program. You probably could do it, but there's no fast and loose programming, because what we're doing is we're comparing the performance of the momentum indicator to the performance of price. And we would expect that those things are kind of in line, right? If the market's moving up, the momentum indicator would reflect that. We talked about how it's calculated, right? It's a comparison of up moves versus down moves. And if we have more up moves and they're of greater magnitude, then that RSI value will be higher. And if it's more down moves, that RSI value will be lower. So we would expect them to move in conjunction. But because it's a bounded study, because the moves are a percentage of there's an averaging factor, there's a percentaging factor. Sometimes they don't move in lockstep, let's call it one for one, all of that good stuff. So divergence is when we see a trend in one indicator or data series that's different from the other. And the question is, which leads which? So bearish divergence is when we're in an uptrend. Okay, we're looking for a divergence of price that might be bearish for the market. And I see it, and I've seen it in most of the stock index futures this year, which is to say, if I were to mark higher highs, and let's equate these higher highs to higher, let's just say higher closes for the most part are in line with higher highs. Not always, but because RSI is calculated on closes, we'll just use the general trend as a substitute for higher closes. I've got higher highs here, but what do I have on the RSI? I've got lower highs. Lower highs. When we reached this high up here before we took a pause, we were at not all-time highs, but really high RSI values we hadn't seen in a while. And as the market kept going, those highs kept dwindling. They were falling off to the point where at this high over here, We couldn't even get above overbought. That's weakness. And that resulted in a turnaround in the market, a pullback, if you will. That's bearish divergence. Now, that's for an uptrend when we're looking for a reversal. In a downtrend, we're doing a similar calculation, and there's a minor divergence here on the E-mini last year, which is lower lows. But look how on the RSI, I'm going to use a path tool. We had lower lows, but then at some point, the lower low wasn't as low as the one previous. So we're trending downward, but momentum is it's improving to the upside. And that sparked this, that could be what sparked this turnaround. And we saw it with the divergence with RSI. So to recap, I do want to just make a couple of points here before we go into the break, which is RSI is probably the number one indicator besides moving averages that most technical analysts and traders use. It's a momentum indicator that helps us understand when things might be overbought, might be oversold. Just because we get into an overbought or oversold territory doesn't mean the market's going to reverse right away. It can stay overbought or oversold for a while. Divergence, look for divergence. It doesn't always happen before a reversal, but it can. And so, it's just a matter of time sometimes of when that turnaround on price follows the momentum indicator. And then we can use the market analyzer to compare different markets that price differently using the same scale on the RSI. It's kind of hard to see here. So we can determine which markets are overbought, which markets are oversold. We get a general understanding regardless of what the price is. We don't have to master a market we don't know. This helps us understand, oh, that price is actually pretty bullish or pretty bearish today.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.